The forward S&P PE is about 22. That's frothy. We know the market's frothy, right? If you look at the miners, they're still bouncing on the bottom. They're like all-time lows. They're not even close to frothy. So we still have 2 more stages to go, and we have 2 more legs to go in miners.
Gold has experienced one of its most volatile years in recent memory. After surging to record highs earlier this year, the metal has given back a significant portion of those gains, leaving investors asking where the next opportunity lies. Now, Don Durrett believes the real opportunity isn't simply in owning gold, it's in identifying the mining companies best positioned to benefit from the next phase of the cycle. Don is the founder of Gold Stock Data, where he has spent years analyzing and ranking hundreds of precious metals companies. Don, it's a pleasure. Welcome back to Top of Mind.
Yeah, Devin, nice intro. Good to be here.
The conversation, I want to get straight into it, Don. I mean, the conversation has become almost entirely now about whether gold reaches $5,000, $6,000, $7,000. Yet, listening to you, and I've heard some of your stuff, I mean, it seems price targets are almost secondary, right? It's more important of a question to actually identify which companies investors own and if those prices eventually are reached. Is that your frame of mind at the moment?
I came to the gold miners from basically the debt bubble. And so you really have to start why you're going into these things. Once you decide, okay, gold is going to be the winner here, and if gold's going to be the winner here, I want to use the miners as leverage. What is the thesis? The thesis is that the U.S. economy is basically gotten to a point now, in kind of an in-game scenario, where it can only do either fight inflation, or support the economy, support economic growth. But it can't do both. It has to choose. We've never been in this situation before. But when I got into gold and silver, my thesis was that that is the ultimate end where you're going to land. You're actually going to get to a point where you get kind of into a doom loop scenario where you're basically, because what we've been doing is we've been expanding the money supply, right? Our debt, our national debt's now 40 trillion, right? 40 trillion, and we're adding 2 trillion a year. So it's out of control, and everybody's starting to recognize it. So that's the thesis. You're like, okay, wait a minute here. Can you really print money to generate prosperity? Can you really do that? No, you can't. So what's happened is we've ended up with a K-shaped economy where a portion of the economy is working, right? The K-shape, the top 10%. It's working for them, right? But everybody else, not so good. And it's getting worse at the lower end, not better, worse. We've gotten to the point where we think that printing money is the be all, the end all. But now, and this is the reason why I believe in gold. This is the reason why I believe gold's going to go higher. Gold's going to be the winner, because we've gotten to a situation now where you have inflation, and you only have 2 choices now. That's why the Fed is completely trapped, which it was an inevitability. Once you let the free market go, which we did in '87. Once you let the free market go, eventually you're going to get to this scenario where the market's basically going to eat you, right? It was that in the movie The Big Lebowski, when he basically says, the bar eats you, or we're getting to this situation now where the economy is going to eat us, and so we only have 2 choices. Really, literally, we have 2 choices. We can either fight inflation, or we can support the economy, but we can't do both. So what does that mean? Stansberry just came out with a new book called At the End of America, and he basically said it's pretty easy to see what's going to happen here, people. They're going to use inflation. They're not going to fight inflation. Forget about that one. They're going to support the economy, and they're going to let the economy grow, and they're going to print money, print, right? It's the only choice they have. Well, that's a dead end. That's a doom loop. Now, I'll end it here. Why did gold go up in January of 24 until January of 26. Why did gold go up $2,600? $3,600. $3,600. It went from 2,000 to 5,600. Why did it go from 2,000 to 5,600? Why? I mean, it's really easy to understand if you're paying attention and you look at history. It's because of what I'm talking about. The US economy is literally the engine for the whole global economy. It's about 25% of GDP. It's the biggest market. And if you look at how big our Wall Street is, 60%, global stock market, 60% is in the United States, 60. So the U.S. economy is like the big gorilla of the world. And our bonds and our dollar are the linchpin of that. So if what I'm talking about, how you don't have, that the U.S. is basically in this kind of this doom loop, this problem area, the rest of the world, if you're a foreigner and you're on the outside looking in, you're going, holy crap, the U.S. is in trouble here. So that's the reason why gold went from 2,000 to 5,600. And that's why gold's back at 4,000, but it shouldn't be. It should be at 5,000. So gold, that was leg one. When we went from 2,000 to 5,600 in January, that was leg one. And silver didn't join the party until August of 25. It waited over a year and waited almost 18 months before silver joined the party. And then it went from $35 to $121 in January. And that was the end of leg one. But there's going to be leg two. And so that's what you need to realize, is that leg two is coming. And I think leg two is going to begin sometime either in Q3 or Q4. And we'll end the year with gold around 5,500 and silver around 80 to 100. And you're not going to stop it. And it all goes back to everything I've been talking about.
Don, I'm going to come in here and ask you about, you're speaking about these monetary interventions and so forth taken by the government. So I would imagine that we're recording this interview now and probably publishing it after the Fed makes its decision on Wednesday with interest rates. What does that mean to you?
There's a zero chance that they hike rates. And come on, man. Who's working at Citadel? There's a zero chance. The only way that they would hike rates is if there was a plan to crash the economy. That would be the only reason you'd hike them. Because if you hike rates, you're literally hiking them into a seasonality issue where AI is basically the only thing keeping the economy above water. And you're going to basically poke that bear? No way. There's no way they're going to hike rates. Then they're going to do nothing. They're going to wait for the stock market to go below 7,000, and they're going to cut rates. I think they'll cut rates at least two times this year, and then 2 times again in the first half of next year. So we'll go down 100 basis points or more in the next 12 months.
Yeah,
that's what's going to happen. Hike rates, no chance.
It's interesting. Listen, I want to bring this back to some of the remarks I heard you say about companies, right? And gold mining companies and mining companies in general. One thing that stood out is your view that roughly 95% of exploration companies simply aren't worth owning, even in a bull market. That's a provocative statement in an industry built around discovery, right? Don, why are you so skeptical of explorers?
Well, the first thing you need to understand about an exploration is less than 1 out of 100 drill holes finds when it's basically a greenfield project. If you're trying to find gold, like 1 out of 100 holes finds basically an economic drill hole, something you can mine, if you will. It is really, really hard to find gold. It's really hard. Now, and now you're going to try to find an economic mine. It's even harder. It's like 999 out of 1,000. The odds are against you. That's why 95% of exploration companies are essentially worthless, because it's so darn hard to find a mine. The only way that an exploration company makes money is they find a mine. And it's hard to find a mine. Really, really difficult. You think about it, and that's gold miners. It's even harder to find silver mines. Right now, if you look at the number of basically, once they build the existing silver mines, the existing silver development mines, and there's only about 5 of them. Once they build those, there's like no more. It's like there's nobody drilling new silver discoveries. There hasn't been a significant silver discovery. And so long, I can't even think of it. A totally legitimate silver discovery. Name it. In the last 5 years, there hasn't been one. I have 2 rules for investing in exploration. The first rule is they already have an economic deposit, and it's undervalued significantly. So it's called an optionality play. So you're basically buying the gold and silver in the ground that's already there. So the risk reward is in your favor. All you need is the price of gold or silver to go up. Southern Silver is a good example. Free Gold Ventures is another good example. These guys are sitting on really large deposits that are valued, way below market price. So optionality, that's number one. The only other exploration play that makes any sense to me is finding a stock that's early in the Lassonde curve and it's cheap. And they have a significant discovery hole. Well, if it's early in the Lassonde curve, it is cheap. So what the Lassonde curve is actually based on the price, the share price. And early in the Lassonde curve means the Lassonde curve goes up like in a mountain, goes, like a mountain curve. So it's going up the mountain. So you want to make sure it's early in the Lassonde curve. So the share price is really cheap. You don't want to buy it at the top of them. You don't want the share price to go up, 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 up. You don't want to be late to the game, basically. You want to be early. And so that's number one. You want to be early, and it has to have a significant discovery hole. Now, what is a significant discovery hole? Well, significant discovery holes are difficult. They're very difficult to find. There's only, on an annual basis, there's usually only about 3. That's it. So you got to be very, very patient. And of those 3, maybe only one of them ends up being a fairly good payoff. So there's like 1 a year of these. Early Lassonde curve is a good discovery hole. So you want the discovery hole, we use something called gram meters. Grams is gram per ton and meters the length. And so you multiply those 2 numbers. And for a significant discovery hole, gold, you want it to be at least 200, at least. And if it's only 200 to 250, that's marginal. Ideally, you want something over 250, over 300, 500 to be great. So if you have a company that, they haven't had a gram meter hole over 100, right? Under 100, definitely under 200. And then they come out with one tomorrow at, say, 500, and they have a market cap of $35 million. Those are beautiful plays. And again, there's only about 3 of those a year. And so those are the only 2 reasons that I buy exploration stocks. But in a bull market that we're in, those, believe it or not, those type of plays in exploration, those are better in a bear market because they always work because they're inelastic. It really doesn't matter what the gold price is for exploration. If they're finding more gold, or if you're buying it way under the price, you're not necessarily going to get hurt. So those will work in bear markets. In a bull market, you can ignore exploration. You can just flat out ignore it. And the reason why you can ignore it is because producers and developers are highly elastic. In other words, they work when the price of gold is going up. And so in a bull market, but they don't work in a bear market. They languish, especially developers. Developers will absolutely eat your lunch in a bear market because they don't generate any income. But in a bull market, they start getting really juicy. And so developers and producers are the best risk reward in the bull market. So you don't even need to mess with exploration. I always tell people, you don't own any explorers, it's not going to hurt you.
Yeah, no, I hear you. Listen, you've called the gold to S&P 500 ratio, Don, the single most important chart for precious metals investors. I mean, most people never use that. What does that tell you today, about the gold price alone? I mean, how do you see it?
You do your homework. I like your questions. I absolutely say that's by far, it's really the only chart that matters for gold and silver mining investors. And the reason why is because it tells you 2 things. The first thing that it tells you is that money is rotating out of stocks and into gold miners because gold's outperforming the S&P. So right now it's about 0.55. It was, I forget in 1980 how far it got to. I think it got to 6, which is absolutely crazy. That means gold was 6 times as much as the S&P, which we're not going to see that. And then in 2011, it was about 3.5, I think. So this time, I think it'll get to 2, which will be a beautiful thing if we get to 2. I'll be happy if it gets to, so when it really turns in our favor is when it gets to 1. But I think it's going to go to 2. So we're at 0.5. So that means gold's going to have to outperform the S&P by a factor of 100% just to get to 1. And then it'll double again to get to 2. And so if gold's outperforming the S&P by that much, all that you can imagine, the money's rotating into the miners. And so that's what we saw both in the 1970s and we saw it in the 2000s. And you have to ask yourself, how did that even happen? How did gold outperform the stock market? Well, it did because the stock market was lethargic. It wasn't doing anything. So people don't really, most people, think that all the stock market goes up. They think it's like housing. All it does is go up, right? Last 15 years, all the stock market has gone up. Historically, we've had prolonged bear markets all the time. Prolonged bear markets are really quite ordinary. So if you look at the S&P 500 in 2000, we didn't have a new high for like a decade. So it's like, so if you would have, if you didn't sell, you're like waiting to get another all-time high, right? You were waiting a long, long time. So what happened? So from 2000 to 2011, especially the first wave, 2000 to 2007, you had gold at $250. It went up to 1900, like 8x, and the stock market was flat. So that's where we had that 3x. Gold was at 1900, and the S&P was 600. So right now, what we're waiting for what we're waiting for as investors is we're waiting for that 1-to-1. So what is 1-to-1? So right now, we have 7,400 on the S&P and 4,000 on gold. We're not even close to 1-to-1. And if you think we're not going to 1-to-1, you're not paying attention. We were at 5,600 gold in January. We could easily go 5,600, 5,600.
It's an interesting point, but if you're right that institutional money eventually rotates out of traditional equities and into precious metals, what are the first signs you'll be watching out for, Don? I mean, does that rotation begin quietly before investors even notice?
No, most people have no idea what's coming. So if you remember, everything that I said earlier in my opening comments about how the U.S. economy is basically manipulated based on money printing, our entire economy is based on the U.S. government borrowing money and expanding the national debt. Our entire economy is based on that. And if it can't borrow money, all hell's going to break loose. So if all hell breaks loose, that means the stock market's in dire straits, right? I think the S&P is definitely going down to 4,500, at least 4,500, and gold's going above 4,500. And so that's that 2-to-1, right? So what's going to probably happen is the S&P is probably going to go all the way down to 4,000, and gold's going to go to 8,000. There's your 2 multiple. Or it'll be 4,500 on the S&P and 9,000 on gold. There's your 2, right? And if you get there, if you go to 2, you can imagine how much money is basically flowing out of the S&P 500 and looking for a home. Gold only needs a portion of that. It doesn't need all of that. I mean, 5% will be plenty to make gold go nuts. It won't take a lot. Now, remember, this is just the U.S., right? Gold is a global market. People all over the world. As a matter of fact, the rest of the world buys more gold than the U.S. does. So the U.S. will just be joining the party. They'll be trying to give us some kind of attitude. And the East is going to go, no, we're not giving you any of our stinking gold. just last month, China imported 173 tons. There's only 3,700 tons last year was mined. 170 times 12, right? That's how much, if they kept importing at this level. But if we just go to 200, it's 2,400 tons just for China alone. And so India imports as much as China. So those two countries alone could easily just soak up all the supply. So there's not enough gold to go around if you have a crisis. That's kind of what I'm saying. Gold's the winner here. And so money will flow into gold, into the miners if the U.S. economy has problems. We've seen that in the 1970s. We saw that in the 2000s. That's what happens. It's history rhyming.
And I suppose how those miners are run are equally important, right? When you analyze hundreds of mining companies, Don, how much weight do you actually place on the quality of management compared with the size or grade of the deposit, right? Have you seen great assets repeatedly destroyed by poor capital allocation?
Yeah. So this is what I always talk about: quality. You want to own quality. You don't want to own marginal. Remember, I said earlier, one of the reasons where people make mistakes is they buy marginal stocks instead of quality stocks. So yeah, you definitely want to own quality, but you want to be smart when you buy, smart when you sell. It's getting starting to get difficult to be smart when you buy. We're still right now. We just had this correction. So we're down at this 200-day moving average where you can still buy smart. There's still, like right now, it's unbelievable. As we speak, the best gold miners are 4 and 5 baggers. So Agnico Eagle is a 4-bagger, which is kind of crazy at $7,000 gold, which I use. Barrick and Newmont both print as 5 baggers, which is amazing. So the best of the best are printed as 4 and 5 baggers. And you can imagine, so you can buy quality right now for cheap, which is amazing to me. I want to own as many quality producers as I can. I own most of them. And so but I'm smart about when I buy them. I don't buy them when they print as 3 baggers. And I like to print, the quality producers 5 to 8, and then the developers about 10 baggers or better. I don't buy a developer that doesn't have 10 bagger upside because they have more risk. So I'm usually in the 5 to 8 for producers and 10 for the developers. That's kind of how I do it. But I'm all about quality. Remember, I use my checklist. I'm always looking. And the other thing you do with quality is you allocate according to quality.
Don, I want to end off by talking about selling, right? I mean, you often say investors sell far too early. So what will convince Don Durrett, for example, that the easy money has been made? I mean, is it valuation, sentiment, free cash flow multiples, or something, else entirely different?
Yeah, once again, I see where you've done your homework. I often talk about, selling too early, selling smart. So a lot of people, I'll give it one example, is like a vino. A vino it went from 40 something cents, up to like $8. And a lot of people were basically taking profits, and there's this idea that it's never a bad idea to take profits. Well, that's true if you're an investor, but it's not true if you're a speculator, because when you're a speculator, you're trying to maximize your upside. So there's 3 ways to invest. The first way is the normal way, which vast majority do, at least 80%, and that is steady accumulation over a long period of time. So you want to make 5 to 20% every single year and just steadily accumulate, right? Just steady growth of your portfolio, right? The second way to invest is to be a little more aggressive, but to also be short-term focused. In other words, you want to grow your portfolio annually, but you want to do it in chunks. You want to make you don't want just the 20%. You want more. You're trying to maximize, and that kind of works for gold and silver miners. The first way doesn't work. The first way, those are the people that come in to do gold and silver miners because they see it as it's got a lot of MOMO. They see opportunity and they get involved, but they have that mindset of steady accumulation. They're kind of breaking the rule. of kind of what speculating. They're trying to invest in a speculative endeavor, if you will. The third way is how I do it is pure speculation. And that pure speculation doesn't care about the near term. I don't care about the next 12 months. I don't care at all until the market gets frothy. And then now we're talking about how to sell smart, right? So those people that took profits in Agnico, they gave away a lot of upside. Agnico, if they don't get acquired, that stock could go to $100 a share. It has that kind of upside potential, but easily $50. So what are you doing selling at 5, 6, 7 when it's going to 50? Why did you really pivot that money into a better stock? So if a stock is running out of juice, if you don't think, it has, for me, if a stock doesn't have 5-bagger upside over the next 2 to 3 years, then it's starting to run out of juice. Then you might swap, but you got to be smart when you sell it. What are you going to swap it into? Are you really confident that, because a lot of times it's really difficult to know. What are you going to swap it into that's going to do as good as that stock? So it's going to get difficult to be smart to sell the top. Now, to finally answer your question, how do you know where is the top? When? And it's really easy. It's basically when the market gets frothy. Well, we know today that the S&P is frothy. How do we know it's frothy? Well, the Buffett indicator, right? All-time high. It's pretty obvious, right? The forward S&P, PE is about 22. That's frothy. We know the market's frothy, right? If you look at the miners, they're still bouncing on the bottom. They're like all-time lows. They're not even close to frothy. So we still have 2 more stages to go, and we have 2 more legs to go in miners.
The founder of Gold Stock Data, Don Durrett, thanks very much indeed for the insights.
Thanks, Devin. It was great.